Oftentimes, when we talk about an under-the-radar name, it's a company on the smaller side. But today, we're focusing on one with a market cap of over $25 billion that trades on average about $40 million a day. It's also a recent addition to the S&P 500. However, it's also driven largely or even solely by passive algorithms. Here to reveal the name, talk about what this means, Herb Greenberg is editor of Herb Greenberg on the Street and Herb's Red Flag Alerts on Substack. He's also a CNBC contributor. Do tell, Herb, what's shaking here?
You know, Kelly, I bet you most people before this was named to the S&P 500 had never heard of Erie Indemnity. And when I first heard of Erie Indemnity, a friend mentioned it to me, and I said, Indemnity, it's an insurance company. I don't want to look at it. No, it's not an insurance company. Erie Indemnity, and when you think about what does Erie Indemnity do and how can this stock have gone up more than doubled over the past 2 years, riding at about $500 right now? Look, the only explanation I have for what this company's stock performance is that its earnings have actually done phenomenally well over the past year, a little over the past year. They've just risen for a reason most people would never understand, and that is this company's primary business. It's not an insurance company, but it's what's known as the attorney in fact for, or which is like a glorified third-party agent for a group of related insurance companies, all part of this Erie family of insurance companies. And their money is made by a fee, a 25% fee that it makes from charging these companies for doing things like issuing policies, handling claims, managing investments, and all that. The fee, this is the important part, the fee is tied to insurance premiums. And we all know what's happened to insurance premiums. Sure. Insurance premiums are going straight up. And therein lies the rub here. The algorithms, by my analysis or my belief, they've tied into the headlines of higher earnings. But you have something here that you know is not sustainable. The minute insurance premiums start to level off, this company's growth will slow down. And I say live by the, die by the algorithm.
Maybe it won't be supercharged, but it sounds to me like a pretty good business model. And let me ask you why you think the algos in particular are keying off of this. This sounds like the kind of name that maybe an active manager who knows a bit about insurance would have been happy to uncover and maybe can stick with if there's a pullback. Maybe if the algos sell when we start seeing, insurance premiums drop, maybe that's the chance for the active manager to scoop it up.
Well, maybe. Look, this company has little to no Wall Street coverage. Most of the big investors are quantitative investors that basically do their investing via algorithms. They're pulled in, they're pulled out, they move around like that. So, and it's not a company, again, it's a fairly regional business. And again, it's tied to fees. All of its revenue is tied to fees by one customer. It is one customer that provides the fees. That creates great risk. There's also one other overhang here. And I had red flagged this a few weeks ago. The other overhang is that PNC, the big banking company, owns about 10% of the shares. PNC, if they ever decide to liquefy some of that, to sell some of that, because maybe they have plans to expand further. This is a sort of hidden asset in PNC that most people never even think about. So that is another overhang to a stock like this. And look, when I red flag companies, I red flag them as stocks to avoid because you would expect them to lag the market, not lead the market. And at this point, this stock looks like one that has a lot of risk.